Today, we will talk about FDIC insured accounts. An FDIC insured account is a bank or thrift account covered by the Federal Deposit Insurance Corporation, an independent federal agency responsible for safeguarding customer deposits in the event of bank failures. The maximum insurable amount in a qualified account is $250,000 per depositor, per FDIC insured bank and per ownership category. An FDIC insured account means if you have up to $250,000 in a bank account and the bank fails, the FDIC reimburses any losses you suffered. For individuals, any sum that exceeds $250,000 for a single account type may need to be spread among multiple FDIC insured banks. Banks use depositor money to make new loans, only keeping 10% of all deposits on hand. This system can create a volatile banking environment, and the FDIC's purpose is to protect depositors from losses due to bank failures. If an FDIC-insured bank cannot meet deposit obligations, the FDIC steps in and pays insurance to depositors on their accounts. A qualified account has to be held in a bank that is a participant in the FDIC program. Participating banks are required to display an official sign at each teller window or station where deposits are regularly received. Depositors can verify whether a bank is an FDIC member through a search at fdic.gov. Generally, all demand deposit accounts held in a bank are covered by the FDIC, and the type of accounts that can be FDIC insured include checking, savings, money market deposit accounts, and certificates of deposit. FDIC guarantees deposits up to $250,000 per account per person. Joint accounts receive $250,000 of protection for each co-owner. Multiple accounts held in the same bank under the same account holder's name are added together for purposes of determining the amount of insured deposits. It benefits savers because they need only worry about finding the best interest rate on a savings account rather than whether their money is safe. The FDIC was created as part of the Banking Act of 1933 after a 4-year period that saw nearly 10,000 U.S. banks fail or suspend operations. The purpose of the FDIC was to restore the faith of panicked Americans following the stock market crash of 1929 and the onset of the Great Depression. Prior to 2006, the FDIC financed itself through the Bank Insurance Fund and the Savings Association Insurance Fund, SAFE. In 2005, the Federal Deposit Insurance Reform Act was signed to merge the competing funds. Since then, all premiums are left in the Deposit Insurance Fund, DIF, from which all FDIC-insured deposits are covered. The FDIC Reserve Fund has never been fully funded, and it is normally short of its total insurance exposure by more than 99%. The FDIC can borrow money from the Treasury in the form of short-term loans if needed, providing further financial backing to the system. However, according to some detractors, forced deposit insurance may create moral hazard in the banking system by encouraging riskier behavior. According to the FDIC, no depositor has lost a cent of insured funds as a result of bank failure since its insurance debuted on January 1, 1934. The FDIC has been a resounding success in preventing bank panics. However, some believe that deposit insurance creates moral hazard in the banking system and encourages riskier behavior. They argue that customers do not need to care which bank makes safer loans if the FDIC is going to bail them all out anyway. Perhaps the most significant benefit of having a FDIC-insured deposit account is that the deposit insurance insures up to $250,000 for each account ownership category in the event of a bank failure. The biggest things not insured by the FDIC are stock investments, bond investments, and mutual funds. Life insurance policies, annuities, municipal securities, safe deposit boxes, U.S. Treasury bills, bonds, and notes, and crypto assets are also not covered by FDIC deposit insurance. It can be safe to have all of your money in one bank, but this is not without risk. If your account balances at one bank exceed $250,000, then that excess amount won't be covered by FDIC deposit insurance in the event of a bank failure. In this scenario, you would be better off keeping some of your funds in a different financial institution. Bank failures, although somewhat uncommon, still happen. An FDIC insured account offers the peace of mind that your deposited funds will be safe should the worst happen at your bank of choice. Here are 3 key takeaways. 1. An FDIC insured account is a bank account at an institution where deposits are federally protected against bank failure or theft. 2. The FDIC is a federally backed deposit insurance agency where member banks pay regular premiums to fund claims. 3. The maximum insurable amount is currently $250,000 per depositor, per bank. Hope this would help. Thanks for watching.